Good morning, everybody. Thanks for joining us today for the Innovate Mississippi webinar series for small businesses and startups. I'm Janet Parker. I'm Director of Business Development for Innovate Mississippi. We're excited to have all of you. Joining us today will be Michael Langdon and Michael Denny with Grantham Pool, and they're going to talk about accounting and tax planning for startups. Real quick, for those of you, let me see if I can change my slide. Oh, I went too far. That's okay. For those of you who are new to Innovate Mississippi, we do work with startups, technology, and innovation-based startups, and help you grow your businesses. If you need our assistance, please contact Tasha Bibb. She is our Director of Entrepreneurial Development, and you can reach her at tbibb@innovate.ms. There's no cost to work with us. Also, if you want to get involved in some of our events, we have our Accelerate conference approaching. I'd love to work with you. You can reach me at jparker@innovate.ms. A little bit about Michael Denny. So Michael Denny works a lot with Innovate Mississippi as a mentor. He's a member with Grantham Pool, and he leads the Financial Planning Services Department. Michael specializes in helping high net worth individuals plan for and execute tax efficient retirements, as well as consulting on investing and estate planning. And Michael has a passion for working with startups and helping young companies thrive. So he's perfect for this audience today. He's an active member of the American Institute of Certified Public Accountants and the Mississippi Society for Certified Public Accountants, as well as the Mississippi chapter of the Financial Planning Association. We also have Michael Langdon. He is a staff accountant with Grantham Pool, and he's a member of the Financial Planning Services Department. Michael Langdon specializes in individual and corporate income taxation, and he's an expert in identifying tax credit opportunities for startups. And he's also a member of the Mississippi Society for Certified Public Accountants. They're going to discuss important topics for entrepreneurs and startups to consider, including choice of entity, setup and structure, basics of setting up an accounting system, capitalization tables, R&D tax credits, and treatment of startup costs. So as usual, if you've been a part of this before, you know, if you have questions, we want to keep this interactive. There is a Q&A tab as well as a chat tab. So type your questions in there. Whenever you're ready, whenever you think of a question, just type them in as you go. We're going to answer those throughout. Also, we have some time reserved at the end to answer all of your questions. And you can also raise your hand. There's a hand raise function. If you want me to unmute your mic, I will be watching for that, and I'll unmute you and allow you to answer a question live. With that said, I'm going to turn it over to Michael and Michael. So we have Michael Denny first. Thanks, guys.
Thanks, Janet. Appreciate the introduction. As Janet said, I'm Michael Denny. And thanks to Innovate, thanks to Janet and Tasha and Tony and the group at Innovate for putting this together. And I'm just going to jump right in and talk about topics that we deal with startups and target it towards startups. But certainly, as Janet said, you know, we want this to be interactive. You know, we did our best to put together some slides that we thought were pertinent based on our experience, but you guys are out in the field and running into things on a day-to-day basis. So feel free to ask questions, and I'll pause. Michael and I both will pause, you know, at certain intervals and allow for questions, and certainly we'll have time at the end. So Janet, can you hear me? Everything good from the audio, technical, video?
Yeah, right now, yeah, we can hear you. If anybody is having trouble, just put that in chat and let me know, and I'll, yeah, I can hear you fine. You might want to project just a little bit more.
Okay, great. Well, I'll try to do that. So I'm just going to jump right in. As I said, these are areas that we deal with startups in and consult with founders and entrepreneurs in these areas. So I'm just going to dive right into to that, and I would qualify what this presentation obviously is directed at specifically at founders and entrepreneurs. Michael and I both deal with a lot of other business and individual type clients. So, but this we tried to target it specifically for startups and entrepreneurs. So as far as entity structure, that's one of the initial consultations that we have with founders. And in a lot of, really, in most cases, that is structured around, we're talking about CCorps versus LLCs, or limited liability companies. We do have a lot of clients that are set up with S corporations, but that's really not a pertinent entity that startups typically look at for various reasons. So I'm going to kind of limit it to CCorps versus LLCs. And so, what you want to think about first is, on the front end, we're thinking about, how's it set up as far as raising capital? Are you going to go out to investors, outside investors, venture capital firms, institutions? Typically, that's something we think about on the front end, and that guides our decision on how to be structured, and we'll jump into that on the next couple of slides. Or is it going to be a situation where it's you and maybe one or two founders, and you're self-funding it and bootstrapping it, and you really don't need outside investors? That may lead you more towards an LLC, as we'll kind of dive into. So think about who are your target investors. Is it more maybe one or two individuals? Is it a number of individuals, institutions, venture capital funds, big funds? Also, you want to think about, how many employees you ultimately are going to have, and do you want to give some of those key employees equity in your business? That's a key consideration. And the last bullet point is really important. It's kind of fundamental importance before we jump into the next couple slides, and that is what we call double taxation, which is what you have with a C corporation versus a flow-through entity or a flow-through structure like you would have with an LLC. And so the double taxation, what that is in a nutshell is that what that means is that the corporation, there's two levels of taxes. The corporation itself is taxed on its net taxable income, and then the shareholders are taxed when a corporation pays out dividends to those shareholders. So an easy example is, think of Coca-Cola is a publicly traded stock. It's a C corporation, as most publicly traded entities are. It's a C corporation, so Coca-Cola pays tax at the corporate level, and it also pays out dividends to the shareholders, and the shareholders are taxed individually on those dividends. And so C corporations are subject to that double taxation, which, as we'll discuss on the next slide, is obviously a disadvantage of a C corp. Whereas the LLC does not have that tax at the entity level. It just flows. There's no tax at the entity level, and it all flows down pro rata to the LLC members, that's members is the technical term for the LLC owners. Those are synonymous terms. So when I say member, I'm also talking about an LLC owner or investor. So with the LLC, again, it's just one level of taxation at the individual level. So jumping into the C-Corps, the pros and cons. I kind of borrowed this first bullet point from a book that I'll talk about later when we talk about some of the resources we have. But basically, the C-Corp is that bullet says it's just simply it's a simple mechanism to provide broad equity ownership, and the key term there being broad. So think of Apple or Coke, they're C-Corps, and they have, of course, broad equity investor ownership. So there's no limit on the number of shareholders. The C-Corps, they make it very easy and clean to issue stock to employees and to advisory board members. And we see that a lot. And we'll kind of talk about that a little bit more later in the presentation. But basically, the C-Corp can have unallocated shares that they kind of hold back for key employees or advisory board members and so on. The C-Corp, one benefit of the C-Corp over an LLC is that there's no what we call phantom income. And so as a startup company is growing and becoming profitable and generating cash, whereas in an LLC, that net taxable income would be taxed pro rata to the LLC members, whether they distribute those profits or not. Whereas a C-Corp, that's not the case. The only time the C-Corp is subject to that double taxation is when it actually distributes out profits or cash to its shareholders in the form of a dividend. So we'll talk a little bit more about that on the next slide when we go into LLCs. The other really good thing about C-Corps and as it relates to startups is the C-Corp allows for different classes of stock. So think of preferred stock versus common stock. So usually when a venture capital fund comes in as an investor, they typically will want preferred stock, which has specific voting rights. It has liquidation preferences in certain aspects and characteristics of that class of stock. Versus a common stock, which may have lesser liquidation preferences or lower related to the preferred stock. So the C-Corp allows for that to be done very easily and structured in that manner. On the legal side, of course, we're not attorneys. We work with a lot of good attorneys here in town on this aspect, but C-Corps have very clear and proven statutory rules and guidelines. A lot of C-Corps are structured in Delaware because their corporate governance structure is very friendly to corporations and to investors. The liability protection is very strong with C-Corps in general, and especially Delaware C-Corps. And so that is one of the benefits of the C-Corp is it has very proven governance rules that have been tested over many years in the court system, and it's it just adds a level of comfort to investors, angel investors, venture investors that come in. They kind of know what they're getting. There's no surprises. There's no unrelated business income tax issues. So with an LLC, as I mentioned, the tax attributes flow through to the individual LLC members. And so when you deal with nonprofit investors, such as endowments or foundations, they may run into issues if you're flowing through in an LLC environment. They may run into issues if you're flowing through income from your business to them, that could present an issue. Whereas with a C Corp, that's not an issue because there's no flow through mechanism. So you avoid that with a C Corp. And lastly, under the pros, there's a, I'm not going to get too deep in the weeds on this, but with a C Corp, it does provide the potential for it to qualify as a qualified small business stock, or QSBS, which basically means if a C Corp qualifies, which a lot of small businesses would, on the eventual sale of that stock, the investors can avoid potential capital gains, and so that can be pretty powerful. If an investor or a QSBS, if you qualify for that, it could substantially avoid some tax on the back end. As far as cons, we've touched on the double taxation of profits, and that's true as a startup is growing and generating cash. To the extent they do distribute it out to the shareholders, you have that double taxation, and that's also true on the quote back end on an eventual sale, which is probably more common in the startup world. I would say, most startups are not going to be paying out dividends along the way. I mean, if you think of even, Apple, for example, just started paying dividends a few years ago. So the other con that I have listed here is this is kind of a pro and a con. So one good thing about C Corps is it's the structure is very set and fixed and rigid, and so that's good in a lot of ways. But that can be a con in that when you're structuring your company, if you go the C Corp route, you don't have a lot of flexibility as it regards to allocating profits and governance, voting rights, or certain really more legal aspects with the C Corp. So
we've got a question about C Corp. Someone has a question.
Yeah, I'll pause here. Janet, was there a question?
Yeah, there is a question about C Corp versus LLC. And so in the event that you're expecting funds to be from a loan from an individual who doesn't have ownership in the company, which would you do, LLC or C Corp?
That's a good question. I don't know that factor alone would push me one way or the other. I would probably look through more of the other characteristics. It may be a good segue. My next slide is actually on LLCs, and so why don't I go through that, and as I go through that, I may help answer the question, if that makes sense.
Hey, there is one more question maybe before you move on, and it may be a transition point as well. But the question is, if you are currently an LLC, can you switch over to a C Corp?
Absolutely, yeah. We've gone through that with a number of entities, and it is easy. It's easier to go from an LLC to a C Corp. It's a form. I think it's 8332 that we file. Basically with the IRS, asking them, to let us be taxed as a C Corp, which they usually agree to. And that's actually, it is a pretty good segue, because that's a point on this slide, transitioning to the LLCs. I think it's under the fourth or fifth bullet point under cons. It's a lot easier to go from an LLC to a C Corp versus going the other way. And so that's certainly, something you want to consider. Um, and I will say too, I think this is also under the con related to the first question. If you're looking at a convertible note, if a loan is a convertible note, that's typically a lot easier done in a C-Corp. And we see those quite a bit in the fundraising world, are convertible notes, because a lot of founders, startups, they don't want to have to pay like a true loan. They don't want to have to use cash flow or use precious cash to pay out interest, every 6 months or however often. And so a lot of times we'll get a convertible note that just accrues interest and then eventually converts to equity on the back end, usually upon some kind of fundraising event, like when a VC comes in and sets a price, and then the conversion is the conversion price of that convertible note is kind of tied to the price set by the venture capital firm. That's the convertible notes are it's not that you can't do them with an LLC. It's just a lot more complicated. So I'll kind of dive in, and this may help answer some of these questions further. As we mentioned, there's flow through of tax attributes, which presumably in the first several years for a startup are going to be losses. And that can provide potential write-offs for investors in an LLC structure. And so, and I say potential because you really have to look at the individual investors' tax situation, and that would govern to what extent they can write off those losses. There could be a scenario or a situation where those losses get quote suspended, and they may not be able to write them off every year. And so but that is potentially one pro of an LLC. There's no double taxation of profits. We talked about that. The LLCs are more flexible as far as their structure. And that's really gets a little more into the legal realm. But you can specifically allocate income and losses in an LLC that you cannot do in a C-Corp. It's basically a simpler way. An LLC, we deal with LLCs a lot, quite frankly, a lot more than C-Corps when we're not dealing with startups, because it is a very simple structure, especially if there's a founder, maybe there's 2 or 3 founders. You don't need to raise outside money from any significant investors, and you don't ever intend to. And the other thing I would point out is if you don't intend to or anticipate having a lot of employees that you want to grant equity to down the road, and LLCs fits that bill pretty well. It would be a lot simpler and really more tax efficient than a C-Corp. The C-Corp would be, I guess, kind of cutting to the chase on all these to the bottom line. The way I would sum this up is the C-Corp is better if you're going to go to outside investors, try to raise capital, some of it, through convertible notes, and eventually, try to raise angel capital, and eventually get to the point where you're going to venture capital and more institutional money. If your startup business is kind of more on that path, the C-Corp, in my mind, in my opinion, is clearly a better way to go. If it's 1 or 2 or 3 founders, you don't need outside capital. You don't really care about giving future employees equity. Not that you can't do that in an LLC. It's just simpler in a C-Corp. But if you're kind of going down that path of bootstrapping it and funding it yourself, the LLC is would probably be a better route. I'll pause there again.
You know, we did have two questions come through. One, benefits of registering as an LLC, tax as S-Corp.
So the question was registering as an LLC and then taxed as an S-Corp. The main reason, and we have a lot of clients that are structured that way. Really, none of them are startups. Those would be more professional corporations or professional service type entities. So think of a physician, for example. We have a lot of physicians set up as S-Corps. And the main reason, the tax savings on that is for what we call FICA tax, for self-employment tax. And so if you're structured as an S corporation, let's say a physician, their gross income is $1 million. So $1 million goes into the S corp. They can pay themselves a reasonable salary from that $1 million. Let's say it's $250,000 reasonable salary that they're paying the full FICA tax on the $250,000. They avoid the FICA tax on the other $750,000. So $750,000 times 3.8% basically is what they're avoiding. So you do the math on that, and that's a pretty significant tax savings. That's the only time we see S corps.
And then the next question was relative ease of registering under an LLC or CCorp versus the other. Right, I guess is one easier to register for than the other.
As far as the registration, you know, from my experience, that I don't think there would be much much difference on the registration end. If there's any, I don't know if Matthew or any attorneys are on the call, I'd probably defer to them as far as the governance, the organizational documents on a C corp versus an LLC. That, you know, that's really more on the legal end, you know, dealing with the attorney. They could probably speak better to that than I could. From a tax and accounting standpoint, I would say there's very little difference. Any other questions?
There are two more questions, Michael.
Okay, sure.
So I'm just going to read these as is. Once you are a Delaware C Corp, is it advisable to do foreign C Corp registration in the state you have an office or a warehouse in? And in this particular case, that would be Mississippi.
Yeah, I think so. You know, we have most C corps are set up, or I should say, a lot of the startup C corps that we work with are set up in Delaware. And again, you know, attorneys can speak to that a little better than I can, but they have clear, you know, governance guidelines. To be honest with you, I'm kind of working through that issue with some clients right now, and I don't know that I have a definitive answer on that. But my understanding, based on what I've seen so far, is yes, you would need to set up as a foreign corporation. And we do have a slide later in the presentation, you know, time permitting, that we talk about the Delaware franchise tax. But I think you would have to establish a foreign corporation in that scenario.
And then one more question. Do C Corps keep your options more open or flexible for various funding options, such as potential grant funding and investors?
It definitely would for investors. Because a lot of the reasons we've talked about, it gives you a lot better structure for angel investors, venture capital investors, investors that want to purchase convertible notes. As far as the grant goes, I don't know the answer to that, to be honest. I wouldn't think it would matter. you know, I think that may be more determined by whoever's providing the grant and any restrictions on their end. I don't know off the top of my head of any issues that it would present from you know, from a CCorp perspective. I don't think it would prohibit that, as far as I know.
That's all the questions so far.
Okay, well, good. That was good discussion. I'm going to hand it over to my colleague, Michael Lang, who's going to hit the next few slides.
Thank you, Michael. Thank you, Janet, for having us. I want to talk a little bit about what comes next. So after you've chosen your entity structure, what do you do next? Well, one of the first things you're going to do is apply for an EIN with the IRS. Now, that's an employer identification number. Think Social Security number, but for business. Okay, it's your unique identifier that's going to stick with you for the life of your business. And what'll probably handle at the same time, possibly, will be working closely with an attorney to draft organizational documents. Those would be articles of incorporation, an operating agreement if you set up as an LLC, and you probably file for the EIN most times at that same time. Then, of course, and we can't stress this enough, you establish a separate banking account completely in the name of your business. It's always advisable to keep business and personal separate. And then, of course, you'll have to decide on what form of revenue recognition is best for you. And you have two methods here, really, accrual versus cash. The main difference here is accrual, you recognize revenue when it's earned, versus cash, you recognize revenue when cash is received. So think of, if you offer a subscription-based service, you may want to think about the accrual method of accounting, simply because you'll earn that revenue over the life of the subscription rather than all up front. And then, of course, you'll want to purchase some form of accounting software. From my experience, QuickBooks is by far the dominant player in this area. Of course, and you'll start to set up your chart of accounts. Chart of accounts is basically cash, equipment, so on and so forth. And as Michael alluded to earlier, when you're choosing your entity structure, of course, determines what tax form you'll file, 1120 if you're a C-Corp, Form 1065 if you're an LLC, and there's a little bit of a difference on the due date, just a month. And you'll want to determine who's going to be your bookkeeper, whether that's going to be in-house or whether you're going to outsource it maybe to a CPA firm. So, and then you'll establish the cap table spreadsheet. Now we have a template that we're going to show you at the end of this presentation on the cap table. With this accounting software, you're going to start, of course, recording transactions through your business, whether it's revenue, expenses, so on and so forth, and you're going to build financial statements. You can see that mnemonic in the first bullet, EBITDA. What is EBITDA? It's earnings before interest, tax, depreciation, and amortization. So it's essentially cash flow. Interest, taxes, depreciation are all non-cash items. So often investors want to see this figure to get a good idea of the cash flow of your business. The two main financial statements, you're going to be looking at a P&L, profit and loss. This is simply revenue and expense items over a certain span of time. And then a balance sheet. Balance sheet is your assets, liabilities, and equity. Of course, assets being cash, equipment, accounts receivable, liabilities being notes payable, accounts payable, and equity being ownership in the business. While you're doing all this, you're most likely going to incur startup costs. Startup costs are basically expenses incurred in the process of starting a business. These can include organizational, opening a facility, consulting, advertising, anything that is normally incurred but it's before your business actually starts. Legal and professional fees, of course. Now you can expense $5,000 of these in the first year, and you have to amortize the rest over a 15-year period, which from a tax standpoint, we don't mind because you're deferring tax deductions in later years when you likely have more revenue. And then particular to this audience, something that we run into a lot, an area that I personally work in, is the R&D tax credit, increased researching activities tax credit. And the reason that this credit works so well for startup entities is because in its pure form, it's applied against taxable income. But oftentimes startups don't have taxable income, or they operate at a loss for the early stage of their existence. But you have the option of applying up to $250,000 of this credit annually against your payroll tax. The reason that that's so good is because payroll taxes are due and payable whether or not you have income. If you pay salaries, you're going to owe payroll taxes. So this is a very, very helpful credit, and it basically keeps more money in your business in the early stages. Now this is reported on Form 6765, and a common misconception is that people don't think that their business will qualify, when in fact, most, if not all, of the startup entities that I've worked with are qualified for this credit. And the gist of it is you do not need to develop a product or a process that is new to the industry. It simply needs to be new to your company. This can be a manufacturing process change or anything of that nature. There's some common expenses that we see that qualify. Wages paid for qualified research, supplies, rental or lease of computers, and contract labor for qualified expenses. And I'll pause there for any questions.
Yes, I do have two questions that came in,
Sure.
Michael's. One is about doing an e-commerce business of personal use products. Would you need to get a resale tax ID for all 50 states or just where your warehouse is located?
I believe that would fall into the nexus issue.
Yeah.
So there's one client that we work on that is an e-commerce business, and they operate in all 50 states. I'm not certain on that. I'd have to look into that a little more.
Okay, well, we can probably figure out a way to reconnect y'all on that.
A little more. And I think I'm going to turn this, if there's no more questions, I'm going to turn it back to Michael.
I do have two more questions.
Got it. Oh, sure.
Or one more actually. Regarding setting up a bank account.
Yes.
If you have rental properties and you're getting paid personally, like through PayPal, can you then transfer those funds into a business bank account?
Yes, you can. You can transfer funds back and forth to the business account. It's just better to keep them separate as far as not handling all of your transactions within one account. If you transfer back and forth to the business account, you basically would consider that a draw or a contribution. So yes, you can do that.
I think that's all I have.
Thank you, Michael. Let's see, I have 11:40, so I think I can probably hit these slides in 10 minutes, and then Janet, if that's good, we can kind of leave a little time for Q&A.
Yeah, that's perfect.
I will say I have to qualify on the we have, I think 80, 85 folks at Grantham Pool. And a number of those folks, I guess because of our size, we specialize in certain areas. Sales tax is not one of Michael and I's areas of specialization, although obviously we deal with it. But I have folks here that specialize in sales tax. So feel free, whoever asked that question, feel free to shoot me an email and we can get an answer. So as far as these last few slides, just going to touch on a few things that we kind of deal with in the world of startups. Typically what we see, what's requested from especially venture capital investors is a 3-year projection of income and expense items. They're typically looking for cash flow. As Michael talked about EBITDA earlier, they're looking for cash flow. They want to make sure that the business can potentially generate cash flow to justify their investment and give them a return on their investment. So it ignores, depreciation, amortization. They're just looking at kind of operational cash flow. And I think you guys at Innovate have a pretty good template that I've seen, the Valley of Death template. Where you kind of go through as a startup. You're hitting your expenses are large and your income's small or non-existent in the first several years, and so you kind of go through the Valley of Death and then come out the other side, and it's a 45-degree line straight up from there. So, but that's there's a lot of good templates out there that we or Innovate can provide you to project out your income and expenses. The fourth bullet there is obviously that's just kind of my opinion, and because we also work with a lot of potential investors and angel investors, and so I think if it's very unrealistic projections on the front end, I think that turns off a lot of angel investors, in my experience, ones I deal with. You want to try to be as realistic as possible. We're accountants, so we love detail and numbers, and so I love digging into the detail. But most people don't. Most people want to see the summary, the summary form. And these change a lot, so you just want to be sure your formulas and in the Excel spreadsheet, which most of these are done in, make sure your formulas are in place so that you can easily update it and change it. The capitalization table or cap table, I'm sure most of you are probably familiar with that. I think I have there's a lot of good templates of these on the internet. This is a pretty good template that I found. I went on Amazon. They had a pocket guide for cap tables. It was very helpful, and with that, they provided this template, which I've used with clients. I'm not going to get into the details, but basically, the cap table is a summary of all the ownership, stock ownership. So, typically this is done with CCorps, but it just summarizes, each round, the angel round, a convertible round, Series A, so on and so forth, and it just, tracks the ownership percentage. And so I found it very helpful to kind of play around with this, because you can kind of see, like in this example, the founders typically get diluted. Their ownership percentage gets diluted, as you can see in this example here. But that's okay as long as the value's going up. Where you get into trouble is on what we call a down round. But anyway, that's I just wanted to share that. But that's what we call the cap table. It's typically one of the first things an investor asks about. So as I said, bullet here, having that at your fingertips where you can just shoot it out and it looks professional and it's accurate, obviously, it's very impressive. So I'd say get familiar with your cap tables. Start with a good template and update it. The last slide I had here, which kind of we had talked about, I know y'all had some questions actually about Delaware CCorps. And most startups are set up in Delaware, or at least we see that a lot for a lot of the reasons we've talked about. One question that I get pretty often is the franchise tax, and so first, I guess before I dive into Delaware, just be aware of the state filing requirements, not only on the, of course, on the tax side, but also on the annual report filing requirements, like Mississippi has, the filing requirements that you just, sometimes those fall off people's radar screen. We try to, with our clients, we have, of course, a very robust due date system capability. And so when it's on our radar screen, we put it on a due date list. But that's just something that can slip through the cracks. But I do get questions about Delaware's franchise tax, and because it can be, in some instances, it can be very high. And so I've found a very good template for this as well that I'll show you. And the way they calculate their franchise tax is kind of confusing, to be honest, because they have two methods to calculate their franchise tax, and they basically use two different formulas. And basically, the point I wanted to get across here is most startups that don't have a large amount of assets are going to fall under this second formula, which is the assumed par value method. And what you want to be careful of in this scenario is having a small number of issued shares in relation to your authorized shares. And so what that means is, what I typically see is a CCorp will authorize 10 million shares right out of the gate. And typically they do that so that they don't have to go back to a board member, to a board vote to authorize additional shares down the road when they're raising money or giving shares to employees, et cetera. You really want to have enough room to be able to do that without having to go back and getting board approval and then going back to the attorney and drafting documents. And so out of the gate, we'll authorize, say, 10 million shares. Well, as it relates to Delaware franchise tax, you want to make sure that you go ahead and issue a large percentage of those shares. And typically that would be to the founders initially, because if you don't do that and your issued shares are very low relative to the authorized shares, then your franchise tax can be astronomical. And so, even if that's this template's nice because you can kind of play around with it, but even if your gross assets are $100,000, which may not be a whole lot, and you have 10 million shares authorized, but you've only issued 1,000 shares, you see your franchise tax is, it can be astronomical in this scenario, $200,000. So So you just want to make sure that you issued a large percentage of those authorized shares. It's kind of the main point I wanted to make here. Let's see, I got 11:51, Janet. I think we are done on this end. I can talk about these resources, but I'll kind of pause here, see if there's any questions.
Yeah, there is a question involving a tax advantage upon liquidation for having either a Mississippi C Corp versus a Delaware C Corp.
I don't think there would be much difference in that. You may be able to avoid some Mississippi tax. It depends on I guess it depends on the extent of the gain, I would say. Because if you sell a Mississippi entity, you can avoid capital gains tax from Mississippi, and so that would be one advantage down the road, to having it domiciled in Mississippi. I'm not sure you could probably get around that, even if you were structured or organized in Delaware. There may be a way you could somehow register in Mississippi as well and get around that. Not sure if that answers that question, but there could, I guess bottom line is there could be some potential benefits to having a Mississippi registered C Corp upon liquidation.
Okay, great. There's another question. I think you answered this already, but I'm gonna state it again just in case I missed this. Can you explain why it's a good idea to issue most of the stock up front? This is for someone who has a Delaware C Corp. And if so, how do you decide how many to issue?
Well, yeah, that's a good question. I would consult. I'd probably consult with your attorney on that, because that's probably more of a legal question than a tax question. But I would say, my point in looking at that Excel spreadsheet earlier on the Delaware franchise tax, if you're based on their formula for calculating their franchise tax, if you do not issue a large percentage of those shares, let me go back there. It may be easier to walk through it. So even if you're a startup, and this is the formula based calculation, Delaware goes through a formula to calculate what they call assumed par value. And so if your issued shares are low relative to your assets and your number of authorized shares, then the way their formula works, basically it results in a large Delaware franchise tax. And so what I typically see is, going back to this cap table, is it's okay to go ahead and issue a large number of shares to the founders, because as you can see later in these in the rounds, fundraising rounds, the founders may be relinquishing some of those shares, but that's totally fine, and that's typical, because they're the ones that are getting diluted on the subsequent fundraising rounds. And so again, I that's where we kind of coordinate with the attorneys, but typically I would issue a large number of shares to the founders and then dilute them in the subsequent fundraising rounds to avoid having to pay a large Delaware franchise tax. Does that make sense?
Yes, thank you. Another question, and this is from an investor standpoint. How often do investors insist on a certain structure or class of stock that then drives a certain structure?
That's a good question. Actually, working through that with the client. Currently, they, if really it's kind of, that's where you kind of have to make a judgment call as a founder, right? Because if it's a large enough investor who comes in and maybe they're going to be your only angel investor, and they're putting up a large enough amount of capital, and they say, hey, I want you to be an LLC so you can flow through those losses to me, and I can take write-offs immediately, and assuming they know their tax structure, as an individual, and they can use those write-offs, then, that's kind of what I advise this client is, hey, if they bring big enough stick, then yeah, I would go with that, if that's your best option for financing. So, otherwise, I think you have to weigh if it's not an ideal situation, it may be, okay, that's one investor, but you have 3 other investors and you want to issue some convertible notes. It kind of goes the more traditional path of what this, kind of what this cap table is showing. It's hard, in my mind, it would have to really be a really good relationship with that investor to trump, not being a C-Corp, if that helps.
Okay. I don't see any other questions. Michael, if people want to get in touch with you, is there a way they can do that?
Sure. Let me get back. I think we had a slide on our, well, I'll hit this real quick, but this, some resources that we've used and really gleaned a lot of good information. Of course, Innovate, Secrets of Sand Hill Road. I recommend that to all entrepreneurs. It's written by Scott Cooper, who runs Andreessen Horowitz, which is one of the largest and most successful VCs in the world. But Scott wrote it to founders and startup entrepreneurs as kind of a guide to, how do you get money. And so that's a really good book. Cooley TO is a law firm. I believe they have a lot of good information on their website. Of course, there's some good podcasts, and I list a couple other websites there. And that is our information. Thank y'all for your attention. Great questions. And feel free to email me or Michael, and we can certainly try to drill down on some answers if we didn't answer them here.
Thank you so much, Michael Denny and Michael Langdon. You guys were great. That was a lot of wonderful information. All of you who are on the call, I'm going to be sending a link to the recording. So if you want to listen to it again, we'll also post that on our website. But thanks so much, guys, for sharing your time and your expertise. We really appreciate you. Everybody, tune in again in 2 weeks. We have another webinar with Brent Upton, and he's going to talk about keeping your data safe from cyber threats. So go on the website and sign up for that. You'll probably get some more information about that from me as well. So thanks so much, and we'll see you in a few weeks.
Thank you all.